Welcome to the 9th episode of Who Said What. I'm Krishna, and this is the show where I dive into interesting comments made by notable figures from across the world, whether it's finance or the broader business world, and dig into the stories behind them. My employment is tied to you guys showing up every week, so thank you for doing that. Today, I'll go over the comments from Aswath Damodaran, Sankaran Naren, and a couple of more people. Aswath Damodaran, who the internet calls the Dean of Valuation, dropped a big statement on his blog recently. He said, the most expensive market in the world is India, and no amount of hand waving about the India story can justify paying 31 times earnings, 3 times revenue, and 20 times EBITDA in the aggregate for Indian companies. Now, first things first, what do valuations even mean? See, at its core, valuations are a way to measure a company's worth. They tell you whether a stock or an entire market is expensive or cheap. Investors look at metrics like PE ratio, EV EBITDA, and EV sales to make that call. But here's the dirty little secret. Valuations are incredibly hand-wavy, and stock prices don't always obey what they say. There's no ironclad rule that connects valuations where the market is headed next. A stock can be expensive and still go higher. A stock can be cheap and stay cheap for years. See, this is why you can't time the market based on valuations alone. But coming to the big questions, are the markets overvalued now? The short answer for this is it depends. If you look at India's market, it might seem expensive based on the traditional metrics. But does that mean a crash is coming? Not necessarily. People have been calling the US market overvalued since 2012. The PE ratio was too high, stocks were too expensive, and guess what? The S&P 500 has tripled since then. If you sat on the sidelines because you thought valuations were too high, you missed out on one of the best bull markets in the history. That's because valuations alone don't drive stock prices. Earnings growth, liquidity, and investor sentiment matters. Now here's a very apt quote from the economist Keynes. Markets can remain irrational longer than you can remain solvent. Basically, just because something looks expensive doesn't mean it won't get even more expensive. And if you try to short the market too early, you might just get blown up in the process. So now the question comes, should you even care about valuations? Yes, but not in the way most people think. See, valuations matter in the long run. If you buy a market at insanely high valuations, your future returns will probably be lower. But in the short term, market sentiment and liquidity run the show. See, this is why people who just rely on PE ratios or EV EBITDA to make investment decisions end up frustrated. These metrics don't tell the whole story. They are just one piece of a much bigger puzzle. See, Damodaran isn't wrong. India's market is expensive, but expensive doesn't automatically mean a crash. It may just mean you need to be a little more smarter about what you own. Adding to the debate, Dhananjay Sinha, the co-head of equities and head of research at Systematics Group, in an interview with ET, noted that India's valuations look stretched, especially when you factor in slower earnings growth. He points out that Nifty's average earnings growth is hovering around 4 to 5% while valuations remain at 20 to 22 times earnings. This creates a significantly high PEG ratio, especially when compared to the S&P 500. PEG ratio for context is like a reality check for a stock's PE by factoring in how quickly its profits are growing. Even if a company looks pricey on a PE basis, strong earnings growth can make it feel more reasonable, while a high PEG ratio warns us that we might be overpaying for slower growth. What's particularly interesting is Sinha's comparison with the US market. While the S&P 500 is showing earnings growth of around 16% with 77% positive surprises this quarter, Indian markets are seeing more negative surprises. See, Sinha's perspective adds nuance to the valuation debate. Rather than predicting an immediate crash, he suggests there can be some more correction before deep value emerges. In other words, Sinha's view aligns with Damodaran's warning. Indian equities might be priced for perfection. But he also cautions that expensive markets don't necessarily collapse overnight. There are many more moving parts, including domestic retail inflows, global liquidity, and broader economic conditions. Since I'm talking about valuations, it would be ignorant of me to not bring up Naren, whose comment last week made everyone in the finance industry go bonkers. Last week, I covered what Naren said, and at that time, it just felt like another discussion. But since then, the finance world, especially the Twitter finance crowd, has lost its mind over it. I'm talking about fund managers, analysts, retail investors, and anyone else who is part of FinTwitter, all weighing in with their takes, counter takes, and counter takes. Now, what did Naren actually say? In his speech, Naren warned bluntly, I think this is the most dangerous year after 2007 to 2008, comparing today's market risk to that of the crisis years.
Went back and thought, I think this is the most dangerous year after 2007-8 from looking at 10-year point of view.
He stressed that banks are keeping their balance sheets safe and taking almost no risks on the corporate side, leaving all the risks with the investor. He said, all the risk is being taken by all of you.
That all the risks are being taken by all of you in this room. So I think this is one thing which I want all of you to think. Don't think 10 years, think immediate.
He also explained that companies are no longer borrowing from banks. They are raising money directly from investors through IPOs and placements. This shift means that retail investors like you and me are now bearing risks that were once managed by financial institutions. Naren even went on to say that SIP can be a double-edged sword if you invest in the wrong asset class. He warned, if you invest in SIP in the wrong product, you are headed for trouble.
If you make a SIP investment in the wrong product at the wrong time, you are headed for trouble.
For those already in small and mid-cap funds, he advised a clear exit. This is the time to clearly take out money from small and mid-cap funds. If you start thinking of 2035, you will regret it.
This is the time to clearly take out money from small cap and mid-cap funds. You can't think of 2035. In my opinion, if you start thinking of 2035, there is a period where you will regret before that, in my opinion.
He even pointed out that valuations in these segments are extremely high, citing a median PE ratio of 43, which only adds to the risk. Now, it is important to note that Naren has been warning about these risks for over a year now. Back in early 2024, he was already pointing out that valuations were getting stretched. And by mid-2024, he was cautioning that SIPs in small caps might not deliver the returns many expect. I saw an interesting tweet that highlighted the trend that FII ownership of mid and small caps are at an all-time high and that of large caps are at an all-time low. He then further compared today's market with peaks seen in 2007, 2010 and 2017. Another tweet from Amit Mantri, a fund manager, noted that although median small and mid-cap valuations have dipped slightly compared to 7 months ago, they remain at levels never seen before in Indian history. Meanwhile, this tweet from another fund manager, Prabhakar Kudwa, pointed out something that contrasts with what Naren said. He said that while timing the market sounds appealing, if you know when to enter, you'd already know when to exit, a luxury few actually have. Adding another perspective to all of this, Deepak Shanoy, founder and CEO of Capital Mind, offered a measured counterpoint. He observed that despite all the talk of stopping SIPs in mid-caps, a 10 to 20% dip is normal and should be expected. He cautioned against knee-jerk selling, arguing that blind selling isn't a great idea when market corrections are part of the cycle. This leads to a critical question for retail investors like us. If one of us follows Naren's advice on when to exit, who tells us when to enter? If perfect timing were possible, wouldn't knowing one imply knowing the other? An investor like you and me would have to be right twice, both at entry and exit. And that level of precision is something most people simply don't grasp. After his video blew up, Naren gave an interview to ET where he said, I don't want to put foot in my mouth again, but SIP or lump sum, investing in a costly asset class won't get any value. So now where does that leave us? Should we exit or not? See, I'm not an expert either, but I'll put forward this question again. If we follow Naren's advice on when to exit, who will tell us when to enter again? Now for the third comment, the former Chief Economic Advisor Arvind Subramanian made a big statement at an event. For about 2.5 years till January 2025, the RBI followed a highly unfortunate exchange rate policy. It was very costly for the economy and sadly it went unnoticed below the radar. To understand why this is such a big deal, we first need to break down how exchange rates work. See, the value of Indian rupee against the US dollar is determined by supply and demand. If more people want dollars for imports, foreign investments, etc., the dollar becomes more expensive and the rupee weakens. Conversely, if demand for rupee rises, its value strengthens. See, most countries follow a flexible exchange rate system. meaning that market forces rather than government intervention determine a currency's value. However, central banks like the RBI sometimes step in to prevent extreme swings that could destabilize the economy. Now, India's central bank, which is the RBI, traditionally follows a policy of managed flexibility. See, this means that while the rupee generally moves based on market conditions, the RBI steps in if things get too chaotic. Now, it can do this by buying or selling dollars to influence the rupee's value. Let me take an example. See, if the rupee is falling too fast, the RBI can sell dollars and buy rupees, making rupees scarcer and supporting its value. On the other hand, if the rupee is getting too strong, the RBI might buy dollars and release rupees into the market, ensuring that the currency doesn't appreciate too much. A few weeks before his statement, Subramanian, along with economists George Fellman and Abhishek Anand, published an article in Business Standard. They argued that RBI had abandoned its traditional flexible exchange rate policy and unofficially pegged the rupee to the dollar. They pointed out that roughly in the last 2 years, the rupee was surprisingly stable, even when global conditions suggested it should have weakened more significantly. Fellman, Anand and Subramanian argued that the RBI kept the rupee artificially strong by repeatedly selling dollars, preventing it from depreciating. While this made imports cheaper and controlled inflation, it had a negative impact on Indian exports, making them less competitive in global markets. They also highlighted the rise in external commercial borrowings or ECBs, which are loans taken by Indian companies from foreign lenders. See, their argument was simple. The RBI's actions created an environment where borrowing from abroad became more attractive than borrowing domestically. When RBI keeps the rupee artificially strong, it makes foreign loans cheaper for Indian companies because they expect to repay them at a stable or stronger rupee rate. This led to a sharp rise in foreign borrowings, with Indian firms increasingly opting for external loans instead of taking credit for domestic banks. Now, this became a concern because higher foreign borrowing increases India's vulnerability to exchange rate risks. If the rupee were to suddenly weaken, these companies would face higher repayment costs, which could strain corporate balance sheets and put pressure on the overall economy. Pranav from the team had written about this, so I'll just read what he said. In a recent paper, RBI pushes against this narrative. It claims that markets don't always reflect any deeper fundamentals about an economy. Many short-term factors can distort prices. In particular, foreign portfolio investors or FPIs often invest with shorter time horizons and buy or sell something based on momentary price movements. This creates a substantial amount of volatility, as large sums of money can enter or leave a country overnight. In times of excessive market froth, speculators bring a lot of hot money to currency markets, making bets that don't reflect underlying trade activity. These sources of money are temporary and volatile and mess up the real prices of currency. To the RBI, these affect currency prices much more than a country's actual economic condition. Now there's another report from SBI which challenges some of the claims made by Subramanian, Fellman and Anand. One key argument from their side is that RBI's policies encourage Indian firms to borrow more from foreign markets instead of domestic banks, increasing India's external commercial borrowing. According to their analysis, some of the borrowing figures used in these claims included foreign investments in Indian bonds, which are not the same as corporate loans. This means that the reported surge in ECBs may not have been as dramatic as Subramanian and his colleagues suggested. So what's the truth? Hopefully we get to know soon, because I am as clueless as you are. Now for the fourth comment, I'll talk about critical minerals. Javier Blas is a well-known Bloomberg opinion columnist who focuses on energy and commodities. He's also the co-author of The World for Sale, which dives deep into how the global resource trading really works. In his recent piece, he talks about how a handful of metals that many refer to as critical minerals, but that he prefers to call minor metals. There's one particular line where he notes how the term critical minerals can be great for a company's image, or a lot sexier as he puts it, especially when firms want to boost their share prices. By branding them as critical, there is an aura of urgency and importance that can be appealing to investors, even though the overall market size of these metals is relatively small. So what exactly are these critical minerals or rare earth metals that everyone is talking about? See, these terms refer to metals and minerals that play specific and often vital roles in modern tech. They can be essential for manufacturing smartphone screens, solar panels, certain types of ammunition, or specialized steel alloys. The tricky part here is that from one nation's perspective, these metals might be crucial to the national security or industrial strategy, while for another country, they might not be so significant at all. In other words, critical can be more of a geopolitical or a strategic label than a reflection of real scarcity or economic impact. Javier Blas urges not to buy into the hype around China's moves to impose export controls on these minor metals. He provides context by looking at the dollar value of US imports and showing that on a macro scale, the sums involved are actually very small. Even if prices were to rise or China were to restrict exports further, Blas argues that alternative sources like recycling or engineering solutions would probably step in to fill any gaps. In short, it's unlikely to topple the US economy or paralyze major industries, which is a stark contrast to the dire headlines we sometimes see. Then why is the myth of critical minerals so persistent then? See, partly it's because industries and governments toss around terms like rare and critical to emphasize their own strategic priorities. Another factor is that global supply chains for these metals can indeed be concentrated, often in China. This concentration does create a geopolitical leverage. But as Blas says, it's easy for people to sensationalize supply constraints and overlook the fact many of these markets aren't large enough in dollar value to deliver the knockout punch some fear. Ultimately, Blas offers a reality check. Just because a resource is called critical or rare doesn't mean it's poised to trigger a national crisis if one big exporter changes the rules. Now for the last story, I'll talk about America's debt problem. Ray Dalio, who's the founder of Bridgewater Associates, which you might know as one of the world's largest hedge funds, gave 2 interviews to CNBC and Bloomberg recently in which he broke down how the US debt situation could play out. His track record of predicting major economic shifts, including the 2008 financial crisis, makes his analysis worth considering. Here's the core problem. See, the US debt has exploded from $5.7 trillion in 2000 to $34.8 trillion in early 2024. The real issue isn't size. They are increasingly borrowing more money to pay interest on existing debt. Interest payments hit $659 billion in 2023 and are projected to reach $1.4 trillion by 2034. Dalio's research of economic history shows a clear pattern. Countries start borrowing heavily during good times. When problems hit, they print money to pay debts. Their currency loses value. Eventually, investors stop buying their debt. This creates a death spiral where the country must borrow just to pay interest. The US needs to sell a huge amount of treasury bonds, which is about 7.5% of the GDP, but Dalio sees a serious supply-demand problem. There aren't enough buyers. Traditionally, when this happens, the Federal Reserve steps in by printing money to buy bonds, but this risks inflation and weakening the dollar. Here are some of the warning signs he is watching. Central banks showing losses like the Bank of England's negative net worth in 2023, long-term interest rates rising despite Fed easing, the dollar weakening while bond yields increase, rising debt service cost eating up more of the budget. Dalio even points to Japan as a cautionary tale. See, Japanese government bonds became terrible investments due to ultra-low interest rates and a weakening currency. While Japan has managed to avoid a crisis, its economic growth, as you know, has stagnated for decades. See, here are a couple of things Ray Dalio suggested, like being cautious with traditional bonds, holding 10 to 15% in gold as protection, watching high stock valuations, especially in tech, looking at companies that use AI effectively rather than just AI producers. Fifth, being aware that many investors are using borrowed money, that is leverage. He even proposed a few fixes. Cut the deficit from current 7.5% to 3% of the GDP. Do it while the economy is still strong. Use 3 levers: spending cuts, improved tax collection, and careful interest rate management. And require coordination between Congress, President, and the Federal Reserve. Here's a little bit of historical context. Ray Dalio mentions this was achieved in 1992 to 1998, showing it's possible with political will. He emphasizes that the current situation is like late 1998 to 1999. High asset prices, new technology excitement, which is then internet, now AI, and brewing debt problems. Now Dalio isn't predicting doom. He describes what he calls beautiful deleveraging, where a country reduces its debt burden through a careful balance of some deflationary measures, spending cuts, better tax collection, some inflationary measures like controlled money printing, structural reforms to boost productivity, coordinated fiscal and monetary policy. Now, what does all of this mean for people? This means being more careful with investments, understanding these risks exist, and planning accordingly. The biggest risk isn't a formal US default, but rather a steady decline in purchasing power as the government likely turns to printing money to manage its debt burden. Now, all of Dalio's work seems particularly relevant now as 2024 brings high debt levels, rising interest rates, geopolitical tensions, and technological disruption, all while the US government continues to run large deficits. That's it for this episode. Please let me know if you have any feedback for me in the comments below. If you sat on the sidelines, if you buy a market at insanely high valuations, your future is if you buy a market, your future returns will probably be lower. I don't want to put food in my mouth. I don't want to put food